Well, in this morning's U.S. Bank Economic 360, the troubling story unfolding in Detroit. As you know by now, Detroit recently became the largest American city ever to file for bankruptcy, which could lead to layoffs for municipal workers and scaling back basic services like trash collection. Detroit's been declining for decades as the city saw residents and tax dollars head to the suburbs. U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman joins me now with more on this unfolding story. Good to have you with us, Mike.
Good morning, Brian.
What does the bankruptcy for Detroit mean for investors?
Well, most immediately what it means is that if you've invested in bonds of Detroit, if you own the municipal securities that they've issued, you're going to have some trouble. You can essentially think of these bonds like a bank loan. So for instance, if the city wants to build a bridge or improve a sewer line, they will sell these bonds on the open market and then take the money they receive from investors to complete that project. In return, they pay interest periodically to the investors, and then at some predetermined date in the future, they return the original capital. So both sides win in that scenario. The investors like the cash flow that they get from the interest, which is oftentimes tax-free, and the city, of course, gets the funding to fund their operations. Unfortunately, in this bankruptcy, what Detroit is saying is that we don't have the funds to make the interest payments, let alone return your original capital. So if you have the bonds that were issued by Detroit, you're more than likely going to lose your entire investment.
Are there a lot of those bonds out there?
There are, unfortunately.
Oh, man. So are we seeing more of this kind of thing around the country?
We really are, unfortunately. Certainly, Detroit, the largest bankruptcy, grabs a lot of headlines. But we are seeing more and more cities and counties and even states that are in very precarious financial situations. So, you know, Stockton, California, a great recent example of a large city, not as big as Detroit, but one that declared bankruptcy. And unfortunately, I think this is something that we're going to see escalate in the coming years. So, you know, many people think of bonds as safe investments, stable investments, certainly less risky than the stock market. But as these bankruptcies show, that isn't always the case.
So when you're looking at municipal bonds, you can't just automatically think this is a good investment. How can investors protect their investment?
Sure. Well, while there are a growing list of cities and states that are having dire financial situations, there are many, many more that are on a firm financial footing. So sticking with those cities, counties, states that have solid balance sheets, solid cash flow, that's the key to a conservative investment. Probably the easiest way to discern what's safe and what's risky is to look at the credit rating of a bond. So these are grades, if you will, that are issued by companies like Standard & Poor's or Moody's, where they go in and they actually look at the balance sheet, they look at the cash flow, and forward-looking project if this is a situation where you're going to get your money back or one where you might have some trouble. So we caution investors to stick with the highest quality, stick with those high letter grades. It's not foolproof, as we saw in the financial crisis, but those companies have really tightened up their methodology that they've used, so you can rely a little bit more on those grades, but it's a great place to start when looking for a safe investment.
All right, we rely on guys like you for your expertise. Thank you, Mike. We appreciate you and U.S. Bank.
Thank you, Brian.